What appeared to be a pretty ugly session early on actually turned out to be reasonably bullish towards the end, as we saw the S&P 500 close fractionally lower after being down more than 1% early on, and the Russell 2000 actually finished nicely in the green today. It was up over 1%. So looked like it was going to be ugly, ended up being a little bit more pleasant. And part of that was as a result of some rumors swirling around that Steven Mnuchin is maybe going to be a little bit more flexible towards his openness towards getting a stimulus package done. We also, of course, are dealing with a lot of earnings results and other corporate news. So we'll take a look at all that, see what it means for our posture going forward. And then I wanted to take a look at a trade application example where we wanted to focus on a large healthcare company recently added to the Dow Jones Industrial Average, where maybe a short put could be in order. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 15th. 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down to the description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Please follow me at Brandon Van Zee, and I encourage you to click like and retweet on these Market Outlook related tweets if you want us to do these as regular as possible. Now, on that point, David is on vacation right now. Some of you saw me joking about that on Twitter this morning. It always seems like the markets go down when David's on vacation, but that means that there will be no Market Outlook video tomorrow. That's the day he usually does it. So he'll be back on Monday as far as I know. In addition to Twitter, we're also over on Facebook. If you want to join our group there, feel free to go to that web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. And this will give us a nice high-level overview of the four major U.S. equity indices. And I guess I should start with what I mentioned in the intro, which was kind of the surprise showing of the Russell 2000. Notice it was up over 1% here today. Pretty nice looking candle, closed near the high of the session there. It looks like that body today engulfed yesterday's body. That's a positive sign, generally speaking, as well. So remember, the Russell 2000 was the one that I mentioned a couple of days ago where we were actually hitting multi-month highs. That did make it a little bit different than all of these other indices where we're still pretty good distance below where we were trading in early September. In fact, I'll take a moment to come over to the internet here briefly because that kind of ties into something I wanted to share with you as well, which is on my Factor Selector tool that I use for our swing trading class on Wednesday mornings. We have seen some nice boosting higher out of the low size factor. You can see that with this green ball kind of on the screen here back at the end of September moved up a couple slots last week and then maintained that strength in this most recent week. So the low size factor isn't quite as strong as the momentum factor, which of course we've been talking about a lot in these various presentations. Think of the Zoom videos and the DocuSigns and those types of companies that I talked about on Tuesday as your momentum cohort right now. They continue to do well. Those stocks in many cases were up today. But low size is kind of quietly developing its own fan base right now, and for good reason. You're starting to see some robust movement out of there on the more near-term perspective. Obviously, longer term, we got a little bit more work to do as the Russell 2000 and other low-size types of indices out there are still not anywhere near their all-time highs, but if you're just looking at the last month or 3 months, you're actually seeing some pretty decent movement in there. So don't fall asleep on those smaller companies out there. There might be something to sift through. While we're over here on the internet, might as well peek over at the sector selector as well. I know we looked at this on Tuesday, so I'm not going to spend too much time on it here, but I did want to at least point out that healthcare did move from number 7 up to number 5 week over week. Reason I'm pointing that one out specifically is our trade application example a little bit later in the video will come from the healthcare area. So maybe some supporting evidence that, maybe there's a little bit of buying pressure there. I don't want to make too much of it. That's not really the driver of the trade, but nonetheless, healthcare did have a nice week over week rebound right there. Also, while we're over here on the internet, did want to say thank you to those of you that clicked like for me on the video on Tuesday. 115 of you did that, and therefore, since we're up and over 100, Plan on giving you the full-length 30-minute version of the video here today. Remember, if you prefer the abbreviated version, the only 15-minute version, I know a lot of you are quite busy, and so if you prefer the shorter version, then don't click like on Twitter. If you prefer the longer 30-minute version, then do click like on Twitter. If we're up and over 100 likes on Tuesday when I do the video next, I'll do the full-length version. If we're under 100 likes, then I will just do the abbreviated 15-minute version. So I kind of put it into your hands as to what direction we go right there. But I do appreciate those of you that help support both David and I on Twitter and other social media venues, as it helps spread the word about our small business to a larger audience than we would be able to on our own. So keep up the great work, and thank you very much. All right, back on over here now to the charts. As far as, the kind of the takeaway after today, again, the kind of the story was we started low. It looked like it was going to be a really dangerous day where we gapped lower in all of these charts cases. It might not have been quite a gap there on the Russell 2000, but definitely a gap here on the NASDAQ after seeing what happened to FSLY yesterday. Some of you, if you're not familiar with that stock, it's kind of the poster child of momentum trading in 2020. FSLY was down 27% here today. Ouch. That is going to leave a mark. We actually got darn lucky on that one in my Monday class for trend trading purposes. We literally just looked at this stock on Monday, but instead the class was wise enough to put Square into our class portfolio rather than FSLY. So we really dodged a bullet there. That would have been pretty ugly right out of the gate, as that company came out with a pre-announcement to their earnings. This was not their normal earnings announcement. It was a pre-announcement saying that their earnings are not likely to be better than what analysts were expecting. So kind of caught everybody off guard, and that stock got absolutely rocked today, down 27%. But as I mentioned earlier, some of those other high-flying momentum tech stocks like Zoom Video actually hit an all-time high here today at 540. That's another one we own in my Monday top-down trend trading class. And then DocuSign is another one we own in that class. It was up 1.4% here today. This one, of course, is where we did a bull put spread on this particular stock a couple of days ago. So I was at least happy to see that Zoom and DocuSign, and another one that we have in my class is Peloton. It was up 3.8%. I was a little bit nervous last night after the bell when FSLY came out and the stock was down 27%. My fear was that it was going to take all those high-flying growth stocks down with them today. So I was very, very pleased at the end of the day when many of these robust trends did not break down. They continued to have buying pressure into the close. So anyway, FSLY was the story of the day and might have impacted the typical tech stock a little bit more so than other areas, and that could be why the NASDAQ suffered the most today. It was down 0.47% today. So about 0.5% there to the downside. But again, we closed near the high of the session, so it could have been a lot worse. S&P 500 was down 0.15%. Dow Jones was down just 0.07%. And it was in the green up until about 10 minutes to go, and then it kind of dipped back into the red again. So the Dow was right there, almost able to turn green at the end, but not quite. In the end, it didn't change our posture. As you can see on the charts, all of our background colors of the charts are still that dark green color, telling us that we have a strongly bullish posture according to the market forecast technical indicator, where we use that green line down below. So that's your intermediate line in that particular case. All right, I'm just trying to check here if we had any bullish intermediate confirmation signals. We do not. Remember, on Tuesday we did, and I was just kind of looking here that I didn't get a chance to listen to David's video last night, but I'm sure he probably would have pointed out that some of these setups ended up being a little bit more ideal in nature, where the blue line was between 50 and 20. Remember my conversation the night before where we had a lot of those bullish intermediate confirmation signals, but we didn't have ideal setups because the blue line was still too high, and I was saying there might need to be a little bit more of an exhale in the coming days before you feel comfortable buying the true dip. And so perhaps there was a little bit of that buying buying that came in today after market participants felt a little bit more comfortable having sold off more than what we saw on Tuesday. So we'll see where that leads us. Remember, tomorrow is the October options expiration day. And that reminds me as well, we have a whole bunch of trades going in this particular venue here. We're going to let our American Tower, so we have looks like a bear call spread. We're going to take that into the close tomorrow, capture our max gain on that trade. We're going to capture our max gain tomorrow on Tesla as well. That one was a little different. That was a bull put spread that we had put on. So we're going to take that max gain tomorrow. And then also down below, Gilead and Coca-Cola, we're going to hold into the close tomorrow as well and take max gains on both of those. So pretty decent month there, all things considered. We did have to take a small loss on our Vornado Realty puts, but in the end, I was happy with the other outcomes that we had for the month of October. So just your friendly reminder here that if you've got October contracts rolling in your own portfolio, make sure you're babysitting it nicely tomorrow and not ending up in the money on any of your contracts if you're not intending to. All right, let's take a look at our next trade setup here, and or I should say chart, not trade setup, chart. We're going to take a look at three green arrows in this case. And so this is chart 4D, and remember the background colors on this chart setup will change based upon whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And for those of you that are not familiar with that vernacular, the green arrows that we're referring to are on 3 different technical indicators: your 30-day moving average. If price is above the 30-day moving average, you get a green arrow. Also, the MACD histogram. If price is above the 0 line, in this case, you're going to get a green arrow. And then the stochastics, if it's trending higher between the reversal zones or just simply in the upper reversal zone, you're generally going to have a green arrow there as well. So anyway, the point is we do have 3 green arrows across the board telling us that these are reasonably good times to be thinking about trend trading. I'm not going to say that they're absolutely spectacular with all of these indices, but if you're picking and choosing your spots, like some of those DocuSigns and Zoom videos and Pelotons that I was showing you a moment ago, those areas do provide excellent trend trading opportunities. And again, for those of you that are premium members of Market Scholars, I'd invite you to join me in my Monday class if you're interested in learning how to trend trade a little bit better. Let's go ahead and take a look now at our 1040 crossover method. Now remember, this particular chart here, 4C, is going to look back a lot further in time. Those other charts that we were just looking at a moment ago are 3 months in length. These charts are 3 years in length. Each one of the candles you see on this chart is 1 week in length. Now, keep in mind, again, tomorrow David's not going to be here. He's out of town trying to enjoy some rest and relaxation, well-deserved. And so he won't be doing the normal Friday presentation for you. But one thing I'm sure he would tend to point out is whether we have any weekly crossovers or not. But with today being Thursday, close enough to Friday, unless there is something truly unbelievable that happens tomorrow, I would assume that we are going to go into the weekend with bullish crosses yet again. And remember, those don't change all that often. What we're basically looking for on this setup is if the orange line is crossing down and below the blue line. The orange line represents the 10-week moving average. The blue line represents the 40-week moving average. And at this moment in time, all of those moving averages are actually expanding away from one another. That's a good positive sign. That's a bullish sign there. So you'll notice that if you just wanted to concentrate on these purple lines down below the charts, if it's tilted higher like they are right now, that means that those moving averages are spreading further away from each other right now. And a couple weeks ago, I was saying how I was getting a little bit nervous that we might end up getting a death cross on the Russell 2000 as those lines were getting pinched together. But we have really seen a beautiful rally out of those small cap areas here in the last 2 or 3 weeks. And so that kind of bailed them out. They're no longer in immediate fear of having a bearish crossover take place. So it'll likely be a few more weeks before we see anything like that, if it's to happen, right? These are the types of signals that can go on for years theoretically. So it's not to say that a signal has to occur, but if it does, it's likely going to be quite some time after having been bailed out here in the small caps in recent weeks. All right, let's now start transitioning our attention on over here to the 12 grid analysis, and let's start with 5A. This is our asset class 12 grid. All right, now as this pulls up, a reminder that the background colors of these charts will change either green or pink based upon the intermediate line on the market forecast and whether it is suggesting that the posture on each of those charts is bullish or bearish, with of course green being bullish and pink being bearish. So you'll notice that we do have one strongly bearish chart on the board, and somewhat surprisingly, at least to me, it's the US dollar. The US dollar does not look all that terrible from a price perspective. We've had a decent little bounce back above that moving average, but because we're still trying to deal with this down trending kind of move that we saw here in the last 2 or 3 weeks, I think that's impacting the intermediate line, which is still at 47 and falling at this exact moment in time. But I could definitely envision this popping back to a bullish posture here within the next week. So we'll keep our eye on that, but right now that's the only one that's considered strongly bearish. We do have 2 other charts on the right-hand side here that are weakly bearish. Those are the lighter pink background colors, and that's REITs. So this is VNQ that we're using here, the Vanguard version of real estate. And in this particular case, the green line is at 73 and falling. So in other words, it had been bullish probably around this time period over here, but as the prices dropped, the intermediate line likely started following suit and now is considered weakly bearish. So it's still sitting right at its moving average. This doesn't look like it's a strong trender in one direction or the other. It just kind of looks like chop and slop to me. So probably a hands-off type of a trade situation on that one. With the U.S. Treasury yield, which is the chart in the lower right-hand corner, we also have a weekly bearish posture on interest rates right now, but they were up today. You'll notice that we closed at 0.73 on the 10-year Treasury yield, and that bounced up and off of its moving average fairly nicely here today. So the moving average remains green on that one, and our intermediate line is very close to the intermediate line on REITs. But in this case, because the moving average is green, I'm going to guess that between these two, if we see one of them go to a bullish posture first, I'm going to bet that it's going to be the 10-year Treasury yield to do it. But we'll see. Remember that when you're looking at the 10-year Treasury yield, it's almost like a Rorschach test when you look at the long bond, which is the chart kind of over here on the left-hand side that I'm circling. Notice that we've had kind of this reversion to the mean move on TLT. It kissed its downward trending 30-day moving average and then bounced down and away from it here today. In fact, you had a bearish engulfing candle there at a resistance area. So that's one that you're going to want to watch closely. If I had to play that one way or another, I'd probably play that bearishly, even though the posture of the market forecast suggests that it is bullish right now. But right now, I kind of see it as a case where the path of least resistance for bonds, at least long-term Treasury bonds, is to the downside at this moment in time. And of course, I'm always willing to change my mind if the facts change. But right now, what I'm seeing is a bounce down and away from a falling moving average. So that's an area where you might want to exercise a little bit more caution, even if you do recognize that the posture itself suggests that it's weakly bullish. Foreign bonds, on the other hand, is a different story. Notice that foreign bonds has been shot out of a cannon here, really, in the last, let's call it 6 or 7 sessions. That's a beautiful move up and off of that rising moving average. This is something I've been pointing out to you guys in the last month or two, where there seems to be a little bit of a divergence taking place between U.S. government bonds and foreign bonds, with foreign bonds really looking much more attractive, at least from a trending perspective. Remember that when prices go up, yields go down. So I suppose it depends upon how you're thinking about your bond investments. If you're looking to trade them, the trend in foreign bonds is much better. And so we had a nice little breakout over both of these prior, congestion zones or selling zones here, and we are now at 3-month highs on foreign bonds. Now, many of you probably don't buy individual foreign bonds. At least I can say I'm not that sophisticated to do it. Maybe some of you are. But if you wanted proxy to that idea in general, then what you could use is this ticker symbol that we use here, which is BNDX. Now, that's not a recommendation or anything like that, but just saying that because it is hard to find foreign bond exposure, if that's something that is of interest to you, then there are a couple of ETFs out there that could help you along with that. So anyway, really nice bounce up and off of that rising moving average for foreign bonds, and is still producing that strongly bullish posture here according to the market forecast. So that's probably the best looking trend on the board from my perspective. Gold was up fractionally today. Oil was down fractionally today, but both of those commodities are kind of dangling right around their moving averages. So trying to decide which direction they want to go at this moment, and just making us wait and see on those. So of all those charts, I would say foreign bonds to the upside looks the most interesting. Let's take a look at sectors now and see if there's anything of interest there, and that's chart 5C. All right, so now as we're looking at the sectors here, these are the U.S. sectors. And remember, this is kind of our traditional view where we're using a market cap weighted bias to it. So these are the well-known XLFs, XLKs of the world from a sector perspective. These are not the equal weight version. These are the market cap weighted versions. But it'll give you a good sense of kind of where things stand, at least from the mega cap and large cap perspective. And you can see that there are 3 charts on the board that are pink. Now, interestingly enough, you might also notice that all 3 of those charts closed up today. In fact, they led the market today, right? Energy had been the worst performer, dark shade of pink right there, but it was up 1.21%. You'll see that financials also have a light pink background in this case. They were up 0.77%, and then real estate in kind of the bottom right hand corner here, also a light pink background color suggesting weekly bearish posture, was up 0.47%. So kind of a strange day where the laggards led and the leaders lagged, kind of a reversal day there of sorts, because you did see like communications and technology struggling here today on a relative basis. But obviously from a trending perspective, something like technology still looks a lot better than something like energy. And it's not to say that that is going to hold forever, but from a charting perspective, that is the assumption we're working off of right now. And as long as you've worked with those types of assumptions in the last 2 years, you've been very thankful for that, because energy has been in a downtrend for a big chunk of that 2-year period, whereas technology has been in an uptrend during that period. In terms of where do we see some of the stronger trends here, it's kind of tough, but what I would say is the 2 that my eye catches is discretionary, which is the chart on the left-hand side here in the middle, and then the chart just to the right of it, which is industrials. The reason that those 2 catch my eye specifically is not only do they have strongly bullish postures, notice that their intermediate lines are well above 80, meaning that they're in the upper reversal zone, but you also have these moving averages that are green that are associated with them. Both of them, you can see, are not quite at their 3-month high, but they are just a few days removed from that. And that does make them different than, let's say, communications, where we're way down below the highs of early September. Same thing for technology. So we've had a more persistent up move there from discretionary, and you can thank maybe like Amazon for that, but I did see that Chewy is another example of a stock that's been popularized. It's up nicely after hours today. It's at 67 as we speak after hours, and it closed at about 65. It was up 1% on a day when the market was down, and then is continuing to shoot higher after hours. So, those types of e-commerce companies like Amazon and Chewy and others, I think, have somewhat benefited the discretionary sector. There are potentially, some retailers out there from a brick and mortar perspective, that might go bankrupt, right? As we're in a difficult economy here, but many of those sales are going to be picked up by the e-commerce giants, and that might help support their stocks a little bit more there as well. And then with the industrials, there's been plenty of transportation stocks. Union Pacific and Cummins come to mind. I was tweeting about Axon International today. That stock really caught my eye. Some of you might not recognize that name anymore, but you'll probably recognize its product, which is Taser. Used to be known as ticker symbol TASR, but has since changed its name to Axon and changed its ticker symbol to AAXN. It broke out to all-time highs here today. It was up 4%. And they do classify that as an industrials company. So you have some kind of peculiar industrial stocks that are continuing to work here. One other thing that I would point out is that some of you might say, well, why did you look at those two as opposed to utilities? Utilities is only a couple of days removed from its high, and it also has a green moving average. And that's true. Utilities is probably right there in the conversation as well. It's just that the consistency of the move has not been anything to write home to mom about. You can see that utilities were stuck in kind of this downtrend for quite some time here, and then just erupted higher over the last 3 weeks. In fact, we had a little bit of a conversation about that here earlier today in my question and answer session. And I'll get that posted on our calendar as soon as WebEx sends that file back to me, which unfortunately has been quite late in recent weeks. They generally have not been sending them back to me until the nighttime, so I do apologize for the delay for those of you waiting to watch the recordings there, but I'll get it posted as soon as I get it in my hands. Anyway, discretionary industrials, I think, are the market's leaders at this exact moment in time from a sector perspective. Now, I also did want to point out that healthcare remains bullish. It doesn't look as strong as those other two, but it will at least kind of play into my conversation with you here in just a second, which let's go ahead and pull up 4A and talk about Amgen. That is going to be our trade application example. Some of you with sharp eyes might have seen my trade and my fill price when we were over there on the trade tab earlier in this video. But let's unveil the idea here. So when you look at this chart, most of you are probably thinking, okay, he's definitely going to be doing something bearish on this, right? And I can't blame you for thinking that way. The stock has broken down here in the last couple of weeks and doesn't look particularly strong. Sometimes I will do bullish trades on really strong stocks like I did on Tuesday with DocuSign. Other times I might have a separate conversation with you in terms of what am I hoping to accomplish with a particular trade. So first of all, let's take a look here at Amgen on this 3-month chart. And let me get a drawn item out here. And I'll kind of show you that this stock has largely been stuck in this sideways kind of channel, I guess you would call it. I know those lines aren't very good. Let me make them a little bit bigger so they're easier to see for you. So there's the bottom one, and there's the top one. So you can kind of see those black lines right there, and you can see why it's kind of interest to me that if you think that a stock is going to continue to channel sideways like this thing has done, where it's captured probably 90 to 95% of its price action right between those two black bands for an entire 3-month period, if you think that that is going to continue, then naturally you're going to want to do something bullish near the bottom of that channel, and you'd want to do something bearish near the top of that channel. So one thing I had noticed earlier in the session is we actually had an oversold cluster signal on Amgen. It didn't finish that way. So remember, I do these trades during the market session, and then I send out the trade results to our premium members at Market Scholar. So that way they have some time to kind of consider the trade idea for their own accounts if they so desire. Gives them a slight advantage over those of you that are just watching it from a free version on YouTube. But anyway, earlier in the session, I had noticed that Amgen was at an oversold cluster signal. And we haven't had one of those in the last 3 months on this company. It's a pretty high quality company. As I mentioned in the intro, it's recently added to the Dow Jones Industrial Average. It's not the type of company that gets whomped too hard to get those oversold cluster signals. So when I saw it today, I'm thinking, oh, okay, well, that's interesting. Maybe this would be an interesting reversion to the mean candidate. And then I saw it, this sideways channel here, and that perked my interest up even more. Now, in addition to that, let me take these lines off before I forget. In addition to that aspect of the trade, I also wanted to show you kind of the process that I use in my dividend classes. Amgen is not one of those companies that has a long history of raising dividends, but they have done a reasonably good job for themselves since they started paying a dividend, which was back here in 2011. You can see this nice stair-stepping fashion taking place here on our chart in front of us, which is suggesting that every year, like clockwork, Amgen is raising their dividend. So while they only have, let's say, 9 years in a row of increases, at least they've done what they could during that 9-year stretch. And they've actually raised them at pretty healthy amounts on a percentage basis as well. So kind of the general idea of this chart is that each stock has its own specific average high yield zones. For Amgen, when this stock has a yield of 2.74% or more, historically that has been an attractive time to buy the stock for the long term. Right now its yield is 2.72. So in other words, its price is just a hair above this blue zone. Typically in my dividend growth investing classes that I teach on Tuesday mornings, we buy a stock when it's already in the blue zone. This one is not. It's right close to it, but it's not in there. So I also teach a class on Monday afternoons called Options for Long-Term Investors, where we do a lot of put selling. In those types of trades, I'm generally looking for a stock that is currently above the blue zone, but is close enough where if we were to sell a put, it would give us a nice, healthy cost basis where the starting yield would be appropriate if we were forced to be put that security. And so that is the type of trade that I implemented for this portfolio here today. I sold the 205 strike for the month of November, and I think we got like 209 out of it, so a little bit more than 1% return on risk. Again, you can check your Telegram for all the trade details there if you're a premium member of Market Scholars. But the general idea behind that is if we're going to be selling the 205, that would put our break even way down here where I'm circling on the chart, easily within that blue zone there. And then, of course, we're getting over $2 for selling that contract. So our true cost basis would be down here closer to $203. And at that point, our yield would be about 3.15%. And this is a company that when it has a 3% yield or better, traditionally finds a bottom. It did so over here as it touched that yellow line, which is the 3% yield. It did so once again right there. It spent a little bit of extra time below that yellow line there, but that's all right too. Things don't work out perfectly. And then bounced again, and then once again spent some decent time in that 3% zone right here. Bounced out of it, bounced down, touched that yellow line one more time, used it as support, bounced out of it, came back down again here during the coronavirus scare earlier this year at a 3% yield, and then had one more opportunity right there in the middle of June, but since then has not offered that 3% yield. So this would be a sneaky way to sell a put if it were to fall, where you could be put that security with a yield in excess of 3%, of course, assuming that the stock closes below the strike price on expiration date. So it does have an earnings announcement coming up, so be aware of that. This is not a trade for the faint of heart. This is a trade for those that actually want to own Amgen for the long term, but would rather buy it at a cheaper price than where it is trading right now. Okay, so that's our trade application example here tonight. Basically a sideways channel where you could get a support bounce in the near term, but in addition to that, have some supporting evidence of an actual long-term purchase with a yield that is in excess of where it's trading right now. So to implement that, we're selling a put to see if that will play through. All right, so that wraps us up for tonight. Again, a solid day in the end, which looked like a really scary day to begin with, but rallied all the way back to nearly break even on the S&P 500 by the time it was all said and done. So tomorrow, check your portfolio. Make sure you're cleaning up all of your options that are expiring for the month of October. Once again, remember, David's on vacation, so there's no video tomorrow, but as far as I know, he'll be back with you on Monday when he's back home as well. So if you got value out of tonight's video and you want me to do another full-length version, including a trade application on Tuesday, I would encourage you to click like for me there on Twitter, where it will be pinned to the top of my timeline. You can also click like on that little Twitter widget underneath the video that you're watching on our website. And as long as we're up and over 100, I'll plan to do a full-length video. For those of you that prefer the shorter version of only a 15-minute abbreviated version of a market recap, then don't click like. And if there's less than 100, then I'll only do a 15-minute version, okay? So with that, have yourself a great rest of the weekend. Enjoy some of these last days of fall before it gets too cold out there for you. And hopefully we'll see you all refreshed back in the stock market next week. Take care, everybody. Bye-bye.